Over the last decade, the average diversified value fund underperformed the S&P 500 by roughly 4 percentage points per year. 4 points a year, compounded over 10 years. That is not a rounding error. That is a generation of investors deciding, reasonably, that value investing is broken. Here's what I'm going to argue in this video. The underperformance is real. The conclusion most people drew from it is wrong. Value investing as a discipline still works. Value funds as products mostly don't deliver what the discipline promises. The gap between those two sentences is the entire subject of this video, and almost nobody in finance explains it cleanly. If you're new here, I don't predict markets. I don't tell you what's going to outperform next year. What I do is take ideas that have been turned into products and show you what got lost in the translation. Today, the idea is value investing. The product is the value fund. The translation has been worse than most investors realize. Let me start with what value investing actually is, because most explanations of it are either hagiography about Warren Buffett or a textbook recitation of price-to-book ratios. Neither of those tells you what the discipline actually does. Value investing is buying an asset for less than you think it's worth and holding it until the market agrees with you. That's the whole discipline. Everything else is technique. The reason it produces returns over long periods is that the market regularly misprices things, not because the market is dumb, because the market is made of investors with short time horizons, career risk, and a strong preference for stories that are working right now. Those features produce systematic underpricing of assets whose stories are not currently working, and systematic overpricing of assets whose stories are. A value investor's job is to identify the underpriced ones, buy them, and wait. The waiting is not optional. The waiting is most of where the return comes from. Now, here are the two features that make the discipline work, and I want you to remember both of them because the rest of the video depends on it. Feature 1 is concentration. A real value investor owns a small number of carefully chosen positions, not because concentration is exciting, but because the analytical work required to identify a genuinely mispriced asset is hard enough that you can't do it for 100 companies at once. Concentration is what allows the analytical work to be deep enough to be right. Feature 2 is patience. A value investor holds a position through the period when the market continues to disagree. That period can last years. The discipline only produces returns if the investor stays in the position long enough for the market to come around. Patience is what allows the analytical work to actually pay off. Concentration and patience. Hold those in your head. Now let me tell you what a value fund actually is. A value fund is a statistical screen applied to a large universe of stocks. The screen sorts stocks by some metric, typically price to book or price to earnings, or sometimes a composite of several. The fund buys the cheap end of the distribution, holds a few hundred of them in a diversified portfolio, and rebalances on a regular schedule, usually quarterly or annually. This sounds like value investing. It is not value investing. Look at what each of those design choices does to the two features I just named. Diversification across a few hundred stocks removes concentration. The fund cannot do deep analytical work on each position because there are too many of them. The analytical work has been replaced with a statistical proxy. The proxy is, this stock has a low price-to-book ratio, therefore it is probably cheap. The proxy is correct on average and wrong in individual cases, which is the opposite of what the original discipline required. Regular rebalancing removes patience. When a position the fund holds continues to decline, the rebalancing rules force selling or trimming. When a position the fund doesn't hold starts to look cheap, the rebalancing rules force buying. The fund's holding period is determined by the rebalancing schedule, not by the time it takes for the market to come around. The patience has been replaced with a calendar. Statistical screens remove judgment. The screen cannot distinguish between a stock that is cheap because the market is wrong and a stock that is cheap because the market is right. Real value investors spend most of their time on exactly that distinction. The fund spends none of its time on it. The fund just owns whatever the screen sorts into the cheap bucket. So here's the position. Value funds remove the concentration. They remove the patience. They remove the judgment. And then they sold the result to investors as exposure to value investing. It is not exposure to value investing. It is exposure to a statistical proxy of value investing, with the alpha-producing features engineered out by design. Which brings me to the evidence. Over the last decade, diversified value funds underperformed. That's the part everyone knows. What's less discussed is the dispersion within the category. Some value managers kept performing through the drawdown. Not all of them, a specific group. Managers like Bill Nygren at Oakmark, the team at Dodge and Cox, Bruce Berkowitz at Fairholme during certain stretches, and a handful of smaller shops most viewers haven't heard of. The gap between this group and the average diversified value fund over the last decade was several percentage points per year. Compounded, it's the difference between value being dead and value being alive. If the discipline were broken, this gap wouldn't exist. Everyone running value would have lost in roughly the same way. The fact that some managers kept performing tells you the discipline still works. It just got separated from the product that bears its name. The managers who kept performing had specific features in common. Smaller portfolios, usually under 50 positions. Longer holding periods, often measured in years rather than quarters. Willingness to deviate sharply from the benchmark. And willingness to look stupid for stretches that could last 3 or 4 years at a time. In other words, they kept the concentration and they kept the patience. The value managers who kept performing were the ones running the discipline. The ones who underperformed were the ones running the product. Now I want to be honest about one complication, because the channel's positioning depends on me being honest about complications rather than steamrolling them. Part of value's underperformance over the last decade was not about fund design, it was about a real structural change in markets. The biggest factor is intangibles. When most of a company's value sits in patents, brands, software, and network effects rather than on the balance sheet, price-to-book ratios stop measuring what they used to measure. A value fund screening on price-to-book in 2024 is running a screen built for a market that no longer exists. That isn't value being broken. That's accounting failing to keep up with what companies actually are. This matters because it means the fund design problem and the structural change problem are both contributing. I'm not going to pretend it's one or the other. What I'll say is this: the fund design problem is fixable. The structural change problem changes what kind of value strategy you'd want to run, not whether running one is worthwhile. So what does this mean for an investor who wants exposure to value? There are 3 options, and I want to be honest that none of them are easy. Option 1. Own a diversified value fund and accept what it is. It is a tilt towards statistically cheap stocks. It is not the discipline of value investing. It will probably modestly underperform the market in periods when expensive stocks are leading and modestly outperform in periods when cheap stocks are leading. If that's the exposure you want, the cleanest vehicles are the large, low-cost value ETFs from Vanguard, iShares, or Avantis. Avantis is worth specifically mentioning because their funds use somewhat better screens than the older value indices, including profitability filters that help with the price-to-book problem I mentioned. They're still products, not the discipline. They're just better designed products. If you're going to own a value fund, this is the honest framing. You're buying a factor tilt, not access to Warren Buffett. Price it accordingly. Option 2. Find a manager who actually runs the discipline. These managers exist. Most of the good ones are closed to new money because concentrated value doesn't scale. A manager running 20 positions can't deploy $50 billion without abandoning the concentration that makes the strategy work. If you're looking, the features to check are specific: fewer than 50 positions. Average holding period measured in years. High active share, meaning the portfolio looks nothing like the benchmark. And a track record that includes multi-year stretches of underperformance, because a value manager who has never had a bad stretch is a closet indexer in disguise. The honest difficulty is that finding these managers takes work most investors won't do, and the ones easiest to find through normal channels are usually the closet indexers. For most viewers, this option is real but impractical. I'm naming it because it exists, not because I think most of you will take it. Option 3. Run a small, concentrated value sleeve yourself. This is the option almost nobody talks about cleanly, because the industry has no incentive to talk about it. There's no fee in telling you to do it yourself. The argument for it is specific. If the alpha in value comes from concentration, patience, and judgment, those 3 things can in principle be executed by an individual investor. You don't need a fund structure to own 10 stocks for 5 years. You need the temperament, the time, and the willingness to look stupid for stretches that may last longer than you expect. The argument against it is also specific. Most individual investors do not have the temperament, the time, or the willingness. The discipline is psychologically brutal in ways that are easy to underestimate when you've never done it. Holding a position that has lost 40% for 3 years while everyone around you owns NVIDIA is not a thing most people can do. It's not a moral failing, it's just rare. My honest view is that option 3 is right for a small minority of investors who genuinely have the temperament for it, and wrong for almost everyone else. If you're not sure which group you're in, you're probably in the second one. The investors who can actually do this know it about themselves, and they usually figured it out by trying and failing at least once. If you do go this route, the sleeve should be small, not because the strategy is bad, but because concentration in a sleeve you don't fully understand yet can damage you in ways the rest of your portfolio cannot fix. Start with 5%. Earn your way up if you discover the discipline is something you can actually execute. Let me bring this back to the broader point, because the specific case of value funds is a window into something larger that almost nobody discusses. There is a gap between an investment discipline and the productized version of that discipline. The gap exists because productizing an investment approach requires scale, and scale requires removing the features of the original approach that don't scale. Concentration doesn't scale, so the product removes it. Patience doesn't scale because investors in the product will redeem during the periods when patience is required, so the product removes it by rebalancing. Judgment doesn't scale because judgment requires a small number of decision makers who can be wrong in costly ways, so the product replaces it with a screen. The result is a product that bears the name of the discipline but is structurally incapable of producing what the discipline produced. Investors buy the product expecting the discipline. They get something else, and when the something else underperforms, they conclude the discipline is broken. It isn't broken, it just isn't in the product. Value is the most visible example of this gap because the underperformance has been so sustained and so widely discussed. But it isn't the only example. The same gap exists in productized versions of momentum, quality, low volatility, and most other factor strategies that started as disciplines practiced by a small number of investors and got turned into ETFs that millions of people own. The gap is not specific to value. The gap is what happens when you productize an edge. The edge gets diluted to the point where it can be sold at scale, and the dilution is the cost of access. Sometimes the diluted version is still worth owning. A factor tilt is not nothing. A value ETF will probably outperform during certain regimes and is a reasonable component of a diversified portfolio. But it is not what its name suggests it is, and pricing it correctly in your portfolio requires knowing the difference. So here's the summary, because I want you to leave with something usable rather than just a critique. Value investing as a discipline works. Value funds as products are a diluted version of the discipline with most of the alpha-producing features engineered out. The underperformance of the last decade is partly fund design, partly real structural change in markets, and the two interact in ways that are hard to fully separate. If you want exposure to value, you have 3 options. Own the diluted product and price it accurately. Find a real manager and accept the difficulty of finding one. Or run a small sleeve yourself if you genuinely have the temperament, and be honest with yourself about whether you do. None of those options is easy. The discipline was never easy. That was always the point. In the comments, tell me which option you're using and why. If you've been told value is dead, tell me who told you, because the people saying that loudest right now are mostly selling something else. And if you think I'm wrong about the gap between disciplines and products, tell me where specifically. I argue back. Subscribe if you want more videos that take apart how investment ideas get turned into investment products and what gets lost in the process. There are several of these coming. One last thing. The investment industry is very good at giving you access to the appearance of a strategy. It is much worse at giving you access to the substance. The gap between those two is where most of the disappointment in modern investing actually lives. Value is the cleanest example. It is not the last one.